Greetings everyone, this is Patrick from AllQuant. Most of you would have already been acquainted with mutual funds in one way or another, so just take today's video as a refresher. Alright, here are the topics we will cover. We'll look at what is a mutual fund, the different types out there, what are the advantages and disadvantages of mutual funds, and how to go about buying mutual funds. So what is a mutual fund? A mutual fund is basically a professional investment management company run by professional investment managers. They are regulated by the industry to carry out fund management activities on behalf of retail investors. They typically target retail investors, although they are also open to high net worth individuals. An individual can invest in a mutual fund by buying units of the fund. Each unit represents a divided interest in the mutual fund. The mutual fund will pool all the invested money together and invest as a collective pool into the stock market. Depending on the mandate of the mutual fund, it can also invest in other asset classes including bonds, commodities, futures, and other alternatives. An individual can also access mutual funds through an insurance company. If you buy insurance, the insurance company will either invest the premiums paid directly to hedge against potential future liabilities, or it can outsource to a mutual fund to invest on its behalf. Some insurance products even put the choice of mutual funds in the hands of the client. For example, investment-linked insurance products allow the insured to choose from among a list of funds to invest their insurance premiums into. Mutual funds are guided by their mandates in terms of what they can invest in. Here are some typical types of mutual funds. Money market mutual funds are allowed to invest in short-term money market instruments like treasury bills and certificate of deposits issued by companies. The intention is to beat the interest rates on short-term bank deposits. There are also mutual funds that specialize in bonds. Such funds tend to invest in mid to long-term government and corporate bonds to earn a higher interest than money market funds. Next, we of course have the stock mutual funds, which invest in company stocks to attempt to participate in the long-term capital appreciation as well as the dividends from stocks. There are also target date or commonly known as life cycle mutual funds. Such funds offer diversified portfolios to match the life cycle of the investor. A younger investor would have a bigger allocation to stocks, and someone nearing retirement would have less stocks and more bonds. In recent years, there are also mutual funds who are allowed to invest in alternatives like commodities, private equity, and even simple hedge fund strategies. What are some advantages of investing in mutual funds? If you are looking for professionals to manage your money, mutual funds offer that option. Mutual funds also provide access to assets other than stocks, as well as access to strategies that are traditionally employed by institutions. Since mutual funds are able to pool investors' money together to invest, individuals who invest in mutual funds are able to benefit from diversification, even with just one unit of mutual fund. Some mutual funds are also able to reap potential tax benefits for the investors from the way they are structured in certain jurisdictions. Now, what about the disadvantages of mutual funds? Most mutual funds are sold through fund distributors. These distributors usually charges an upfront sales charge, which can be quite hefty. It can go up to as high as 5%. Some also charge a trailing fee, which can last for a number of years. This will of course eat into the returns of the fund. Mutual funds are often quoted with a wide bid-ask spread. When you're buying or selling the funds, you are paying the spread. What is worse is that when you put in your orders, you do not know the actual transacted price until you see the confirmation, which comes sometime later. Which brings us to the point of late dealing. Now, unlike stocks where you can trade anytime during regular trading hours, mutual funds only trades at the end of the day in the back office environment. And if you sell your units, you may receive the cash as late as 7 days later. Mutual funds often comes with high running costs, which are passed on to the investors in the form of high management fees. So because of this, mutual funds are facing stiff competition from a newer type of structure called ETFs, which are cheaper and more flexible. Some are even saying that mutual funds are becoming outdated. If you want to learn about ETFs, we have another video just for that. Alright, so how do you go about buying mutual funds? Some large mutual funds market their own funds so you can buy directly from them. But most mutual funds also market through intermediaries like insurance companies and banks. But before you go out and buy mutual funds, do spend some time to look into the fee structure. How much is the sales charge? Are there any trailing fees? What is the annual management fee like? How does the bid-ask spread look like? Compare around similar funds before choosing one. Okay, so that's all I wanted to share on mutual funds. Now please help to smash that like button. And if you are interested in similar contents like this, you can subscribe to our channel. AllQuant also conducts courses on investing, so do visit our website for more information. You can find the link in the description section below. Okay, thanks for watching, and I'll see you at the next video.